99% of Gen Z don't get stocks. Most Gen Z have absolutely zero financial literacy. They have no idea what a stock, ETF, dividend, derivative, mutual fund, asset allocation, and diversification are. They're instead too busy memorizing Italian brain rot, like
Bombardiro crocodilo.
doom scrolling on TikTok, or developing terrible posture like Quasimodo playing League of Legends in their Dorito-encrusted gaming chair living in their mom's basement. It's time to fix all that. If you want no BS information on finances and investing, you've come to the right place. On The Finance Gopher, I'm bringing you accurate, high-quality vetted information so we can make financial literacy accessible to everyone and their mothers. In this video, we'll focus on stocks. What does a stock represent? At its core, a stock is a share of ownership in a company. If you buy one share of Apple, you own a small piece of that business. You're entitled to a portion of the company's profits and possibly dividends, and your hope is that the value of your share increases over time. But that value, the stock price, is not fixed. Stocks are bought and sold on exchanges like the NYSE or NASDAQ, and their prices move constantly throughout the trading day. A stock's price doesn't move because the company itself changes second by second. It moves because of what people in the market think the company is worth at any given moment. So why does the price change? The simple answer is supply and demand. If more people want to buy a stock than sell it, the price goes up. Demand is greater than supply. If more people want to sell than buy, the price goes down because supply is greater than demand. But the deeper question is, what makes people want to buy or sell in the first place? It all comes down to collective expectations about the future. Investors are always trying to predict how much money a company will make in the years ahead. If they think future profits will be high, they want to buy the stock now, before the price goes up. If they think the company will struggle, they will sell to avoid losses. Every bit of news, earning reports, product announcements, leadership changes, lawsuits, economic data feeds into the game of expectations. Prices move because thousands or millions of people update their predictions and place their bets accordingly. Let's say Tesla stock is trading at $250. Two groups of people look at it differently. The optimist believes Tesla will dominate the electrical vehicle market for the next decade. He thinks its investments in AI and self-driving technology will pay off massively. And he believes demand will grow worldwide as gas cars are phased out completely. They're willing to buy the stocks at $250, $270, even $300 because they expect huge future profits. The skeptic thinks competition from Ford, General Motors, and Chinese EV companies will erode Tesla's market share. The skeptic worries that Elon Musk's leadership is unpredictable. Perhaps he'll receive more allegations of extensive drug use. He'll continue his erratic behavior that was observed in the White House, and he'll be embroiled in further controversy after his departure from a role in the Trump administration. The skeptic thinks current valuations are already too high and future growth is priced in. Skeptics want to sell the stock or won't buy above $240 because they don't believe the future will be as bright. Now imagine a new Tesla product launch goes well. A new cheaper model is announced. It's stylish, fast, and affordable. Suddenly the market leans more towards the optimist view. More people want in. Prices start climbing to $275 or more. But a few months later, Tesla reports declining delivery numbers and says battery production is hitting supply chain issues. The skeptics now feel validated. They sell. Others panic. Prices drop to $220. It's not just profit or loss that causes this. It's the gap between what investors expected and what actually happened. You can think of stock prices as being the market's evolving guess about the company's future. That's why stock prices don't just move once per quarter and when earnings are reported. They move constantly, second by second, because markets are absorbing new data, speculation, and emotion all the time. Let's say Netflix announces it added 10 million new subscribers this quarter, way more than expected. Investors think, wow, that's a huge win. More subscribers means more revenue, which means more profit. People start buying the stock quickly, more buyers than sellers, and the price goes up. Now imagine, a month later, Netflix releases another statement. Actually, due to data error, we only added 2 million subscribers, and we're seeing slower, stagnant growth in key markets. Investors react negatively. They feel misled or worried. They start selling the stock. More sellers than buyers, and the price goes down. This isn't about Netflix being a good or bad company. It's about whether it's doing better or worse than expected. The stock market is always pricing in what's likely to happen next, not just what's happening today. So what kind of news or events move prices? Earning reports. If a company makes more profit than analysts expected, its stock often rises. If it disappoints, it usually falls. Economic indicators, inflation, interest rate changes, unemployment numbers, and GDP growth all impact how investors view the future economy, which in turn affects stock prices. Industry news. If a competitor fails or an entire sector booms, for example AI or green energy, it affects related companies. And importantly, company-specific events. Product launches, CEO resignations, legal troubles, or acquisitions can all lead to sharp price changes. And market psychology. Fear and greed play a big role. Sometimes people panic and sell for emotional reasons, not logical ones. Other times they buy into hype and drive prices up unrealistically. Do you remember when 3/4 of Nvidia employees became millionaires? It's because their chips found much wider uses: cryptocurrency mining, self-driving cars, and most importantly, the training of AI models. There's hype around Nvidia, but the bubble may pop at any moment. How about bull markets versus bear markets? A bull market is when stock prices are broadly rising, optimism is high, investors are confident, and people are willing to take more risks. A bear market is when prices fall broadly, usually 20% or more from recent highs, and fear dominates. These terms refer to overall market trends, not specific prices, but they reflect the mood of investors. It's not about a specific stock being at $20 or $200. It's about the direction it's going and the confidence behind it. Okay, so to all you Gen Z, actually it's unfair to assume that you're all Gen Z. There might be some millennials, some Gen X, maybe some baby boomers, and probably very few of the silent generation, which I actually haven't heard of before. Here's what you need to remember. Stock prices rise and fall because investors constantly reassess what a company's worth based on new information and changing expectations. The price is the result of a market-wide negotiation between all buyers and sellers, and that negotiation is driven by human beliefs, predictions, emotions, and reactions to data. It's dynamic, messy, and deeply tied to psychology and probability, not just math. Stock prices are like bets on what happens next. If reality beats expectations, prices go up. If reality falls short, they go down. Sometimes people ask, but isn't a stock just worth what it's worth? The truth is, there is no single fair price for a stock. Everyone sees value differently, as cliche as it sounds, and that's why prices move. The market is like an auction where the price constantly adjusts based on the crowd's mood, information, and expectations. If you learned something new today, please hit the like button and subscribe for more content like this. Thank you very much for tuning into this video, and happy investing!